Welcome back to the On the Money Allied Wealth YouTube page. This is Ryan Wheless bringing you some interesting stuff today about what's going on this year in the markets with the 60-40 portfolio. In fact, I've referenced this article a couple of times already, but the Wall Street Journal put this out recently, and it says here the classic 60-40 investment strategy falls apart. There's no place to hide. Well, a lot of people were asking me, Ryan, I thought this strategy of 60-40 was supposed to protect me in up or make me money in up markets and protect me in down markets. Why is it not working this year? Why is there no place to hide? Well, folks, the reality of this is we have to understand something. So the 60-40 portfolio strategy works like this. 60% of your money is in stocks and 40% of your money is in bonds. And so the bonds are supposed to offset losing stock prices in down markets, right? And because the way this stuff is supposed to work is an inverse relationship, which I'll talk about here in a minute. And then if stock prices are going up, bonds are losing a little bit, but the stock price appreciation is offsetting the bond losses. So the way this kind of works is it's supposed to be like in a football team, right? On a football team, you got guys that run the ball, catch the ball. You got guys that throw the ball. You got guys that are fast or slow. Some guys are fat. Some guys are skinny. Some guys are huge. Some guys are small. Some guys run the ball, kick the ball. But they're all working in a common effort to score touchdowns and ultimately win the Super Bowl. By the way, that's how you describe diversification in a portfolio, by the way, by describing the football team. And to that end, that's what's supposed to be happening in the 60-40 portfolio. And here's what's going on. What happens here is if bonds are going down, stocks are supposed to be going up, right? So if stocks are going down like they are this year, bonds are supposed to be going up. Well, folks, that's not happening right now, and that's why so many people are losing money in a balanced portfolio. The reason why it's not happening is something that we've been just screaming from the rooftops at Allied Wealth and On the Money for quite some time. And the reason this is not happening this year is the bond market is going down at the same time as the stock market. Now, why is that? It's really important to understand here. You see, bonds and interest rates have an inverse relationship, almost like a teeter-totter or a seesaw, all right? And so the way this happens, folks, is if interest rates go down, bond values go up, okay? That's the way it works. Well, what's happening right now, folks, in this year is all the low interest rate environment we had for so long is coming to an end, and the Federal Reserve Bank is saying, hey, we've got massive inflation as a result of all the stimulus we put into play during COVID. We've got to fix this problem. So what can we do? Well, we have to raise rates. Well, if they start raising rates, we understand that when rates go up, bond values go down. It has an inverse relationship to rates increasing. So now what's happening, folks, is the typical inverse relationship of bonds and stocks is not happening this year because bonds are losing money and stocks are losing money at the same time. The bond market's been down as much as 16% this year, the stock market down as much as 25%, and the balanced 60-40 portfolio has been down about 22% this year. A lot of people who invested money in that portfolio never saw that portfolio being down that much to begin with. But folks, it's a great explanation of what's going on with the bond and stock market this year, and the inverse relationship of bonds and stocks has completely evaporated on so many of us when we need it the most. I'm Ryan Wheless. This is the Allied Wealth On the Money YouTube page. Give us a like down below, hit the subscribe button if you like the content we're putting out.